Hello everyone, welcome to this video tutorial. In this video, I'm going to explain the week 10 workshop questions. The reason is due to potentially some technical glitch, the week 10 workshop has not been recorded. So this video is a replacement for the week 10 workshops video. So as usual, I will first of all share the workshop questions. Okay, so this is our first question here, and I will assume that you have already watched the week 10 lecture video, so you have understanding of what we have covered in this week. So first question is, in 2014, Entourages paid a regular quarterly dividend of $0.83 per share. Match each of the following dates. So you can see that we are given with some dates like Friday, July 25, Monday, Tuesday, Tuesday, August 12, Tuesday, August 14, Tuesday, September 2, and record date, payment date, and so on. So as we discussed in the lecture, that first of all, company announces its dividend, so which is the dividend declaration date. Okay, so which means that the first one, which is July 25, that should be the dividend declaration date in which the board of directors announces the dividend. Okay, and once this dividend is declared, then the company will specify a particular date, which we call record date. And on the record date, a shareholder's name must appear on the company record book to be eligible to get that year's dividend. Okay, however, there is some time length required between a share purchase and getting the entitlement of that share. Okay, and this time period is usually 2 days. And that's why a share will go ex-dividend 2 days before the record date. And if you want to buy this year's dividend, then you have to buy the share before the ex-dividend date. Okay, because on the ex-dividend date, the share, if you buy the share, you will not get the entitlement of that share by the record date. As a result, you are not eligible to get dividend. So Monday, August 11 should be the last with dividend date. Okay, which means that if you want to get this year's dividend, you have to buy the share by August 11. Then August 12 is the ex-dividend date. So on ex-dividend day, you are no more, if you buy the share on ex-dividend day, you are no ex-dividend date or later, you are no more entitled to get this year's dividend because of the time length that I mentioned. Then August 14 is the record date. So on this date, the company will check the register and all the registered shareholders will get the dividend. And payment date is the date on which the dividend is actually, dividend amount is actually transferred to the shareholders' bank account. Okay. The next question is, one of these dates, the stock price fell below by 0.83. Why by 0.83? Because that was the dividend paid. Look, as I already mentioned that on the ex-dividend date, you are no more entitled to get this year's dividend. That's why share price should decline by the amount of dividend on this date, because before the ex-dividend date, share price reflects the share as well as this year's dividend. But on ex-dividend day, it excludes this year's dividend. That's why share price should decline by this. Okay. The next one is Entourages stock price in August 2014 was 71. What is the dividend yield? So what do we mean by dividend yield? Dividend yield essentially is the rate of return you earn if you buy the share at this price. Okay, so dividend yield is annual dividend divided by the stock price. Now look, $0.83 dividend was paid, but that was quarterly dividend. So we multiply it by 4 to get an annualized dividend, and then we divide it by the share price, which was 71. And if you calculate this, it is 4.68%. So what does this number reflect? What does this number reflect? This number actually tells you that if you buy this dividend or share at the current price, which is $71, and you get this dividend, you are actually earning this 4.68% return. Okay. The next one is Entourages forecasted earning per share were about 5.9. What was the payout ratio? So what is payout ratio? Payout ratio is the proportion of earning paid out as dividend. Okay. So payout ratio is annual dividend divided by annual earnings. So the proportion of earning paid out as dividend. And once again, what is the amount of dividend? This, right? This, and divide by an earning per share was 5.9. And if you calculate this, you will see that it is 56.27%. So which means that the payout ratio was 56.27%. The 56% of the earning was distributed as dividend. Okay. The last part of this question is, suppose that Entourage paid a 10% stock dividend, what would happen to stock price? Look, dividend is not only paid in cash, dividend can also be paid in stock. So when you get stock dividend, some additional stock will be added to your holding. Now, in this case, 10% stock dividend is paid, which means that if you have, for example, 100 share, it will be added by 10%. So your stock number of stock will be 110. Okay, once that stock dividend is paid. But you need to keep it in mind that it's just a cosmetic change, because some additional stock is given to you. It doesn't make any change in the company fundamentals. That's why the stock price of the company should decline by that proportion of a stock dividend. Okay, because the number of share increases here. 100 share becomes 110. So expected stock price, how do we calculate this? Expected stock price is $71, which is the current price, and the stock dividend rate is 10%. So we divide it by 1.1, and it is 64.55, right? So which means that after the stock dividend is paid, the stock price will decline by 64 point. The stock price will decline to $64.55. Okay. Let's go to the next question. Next question is, Seashore Salt Company has surplus cash. Its CFO decides to pay back $4 per share to investors by initiating a regular dividend of $1 per quarter or $4 per year. The stock price jumps to $90 when the payout was announced. The question is, why does the stock price increase? Well, this is a theoretical answer. The stock price increases due to information content of dividend. In the lecture video, I have explained this concept that when a company provides a dividend announcement, it has an information content. That means investors derive signal from this decision. So when a company announces a new dividend or an increase in dividend, that gives a positive signal in the market, because shareholders perceive that this increase in dividend or initiating dividend not only provides us this cash return this year, it also signals that management is confident about the company's future earnings, about the stability of the earnings, or it reflects the management confidence that the company will be able to generate these earnings and maintain this dividend in future. So that's why an increase in dividend provides a positive signal that share price should decrease, and a decrease in dividend will just give an opposite signal in the market. And what happens to the stock price when the stock goes ex-dividend? So I already mentioned that when stock goes ex-dividend, the share price will decline by the amount of dividend. Okay. The next question is, Surf and Turf Hotels is a mature business, although it pays no cash dividends. Next year's earnings are forecasted at $56 million. There are 10 million outstanding shares. The company has traditionally paid out 50% of earnings by repurchases and reinvested the remaining earnings. With reinvestment, the company has generated a steady growth, averaging 5% per year. Assume the cost of equity is 12%. Calculate Surf and Turf's current stock price using the constant growth discount cash flow model in chapter 4. If you can remember, we have learned DCF model of share price determination in chapter 4. We know that share price is the present value of future dividends, right? So that is the discounted cash flow technique. And we need to apply this model. So let me first of all copy the answer for you, then I explain this to you. Okay. Look, first of all, we calculate the total value of the shares, which is market capitalization. Look, when we use that discounted cash flow model, we had price equals to dividend divided by K minus G. K is the required rate of return, G is the growth rate, and next year's dividend was given. Okay, but in this case, we are not given with the per share dividend. That's why we deal with the entire value of share. So we do a little bit of back calculation. Okay. So look, that total forecasted earning is 56 million. Okay. And we know that 50% of the earnings will be paid out as dividend, and 56%. 50% of the earning will be retained. So 1 minus retention ratio. So 50% is the dividend ratio. So this is the total dividend, not per share dividend, total dividend for all the shares, and divided by K minus R minus G, required rate of return, and the growth rate. And this 400 million, this is the total value of the shares, not the par value, which is called market capitalization, number of share multiplied by per share. And if we have so, we divide it by the number of share, which is 10 million. So we get the stock price per share. So a bit of back calculation to find out the stock price. The next part of the question is, now Surf and Turf CFO announces a switch from repurchases to a regular cash dividend. Next year's dividend will be 2.8 per share. CFO assures investors that the company will continue to pay out 50% of earnings and reinvest 50%. All future payout will come as dividends. So what would you expect to happen to Surf and Turf's stock price and why? Okay, now we have a more straightforward information because per share dividend is given. So we can calculate the share price straight away now, rather than going for a back calculation as we did previously, right? Okay, so dividend 2.80 R minus G, and we see that stock price is $40. Okay, which was the stock price previously. And what happens to stock price? The stock price doesn't change because once again, it's just a cosmetic change that the company switches from repurchases to dividend. So these are two ways of distributing cash. Okay, that's why it doesn't have an impact on share price. Next question is again a theoretical question. Investors and financial managers focus more on changes in cash dividends than on the level of cash dividends. Why? So once again, I discussed this point in the lecture video, and there we have seen that what matters is a change in dividend. Okay, because change in dividend provides a signal in the market that I just mentioned a few moments back. If it is a positive change, I mean increase in dividend, it provides a positive signal in the market. And if it is a negative change, that means decline in decline in dividend, then it will give a negative signal in the market. That's why managers are more concerned about changing the dividend rather than keeping the dividend as it is. For example, if last year's dividend were $2 and this year dividend is also $2, this is just a routine decision. However, if last year's dividend was $2 and this year's dividend is $2.5, then it is an important decision because that provides a positive signal in the market, and manager never like to change dividend unless they think that they can maintain it in the foreseeable future. And what is meant by information content of dividend? I already explained it in one of the earlier questions. Question number 5. Here are key financial data for House of Hearing Incorporated. So what we are given is earning per share, number of share outstanding, target payout ratio, planned dividend per share, and stock price. House of Hearings plans to pay the entire dividend early in January 19. All corporate and personal tax were repealed in 2017. Other things equal, what will be House of Hearings' stock price after the planned dividend paid out? Okay, so this is very straightforward. We know that stock price will decline after the dividend payout. So 130 is the stock price, and dividend is 2.75. So stock price will decline by this. So share price will be 27.25. So that's a very simple question. The next one is, suppose the company cancels the dividend and announces that it will use the money saved to repurchase shares. What happens to stock price on the announcement date? Once again, the announcement date, stock price doesn't change. Why not? Because I said that dividend and stock repurchase, they are just two ways of distributing cash. That's why for switching one decision to another will not have any impact on share price. Assume that investors learn nothing about company's prospect from the announcement. How many shares will the company need to repurchase? So they will cancel the dividend and they will repurchase. So how many they can repurchase? Okay, now look, how many shares the company has? 40 million, am I right? 40 million. And how much is the dividend? 2.75. So how much money you save for not providing dividend? So this amount, right? 40 into 2, so 0.75. And to repurchase, each stock will cost 130, right? As a result, you will be able to repurchase 0.846 million shares. Okay. The next one is, suppose that instead of canceling the dividend, the company increases dividend to 5.5 per share and then issues new shares to recoup this extra cash paid out as dividends. What happens to the with and ex-dividend share prices, and how many shares will need to be issued? Again, assume investors learn nothing from the announcement about House of Hearings. So now the company doesn't cancel dividend, rather they increase dividend, okay? And to increase dividend, they issue share price. They issue new shares because they need more money now. What happens to with an ex-dividend share price? Once again, share price is 130, so with dividend share price is 130, and ex-dividend share price is after we deduct the dividend, which is 124.50. Okay. Now the question is how many shares they need to issue. Now look, they are going to pay a dividend of 5.5. Their previous dividend was 2.75. So they are paying an extra dividend, right, of these, and 40 million shares. So this is the extra dividend they will pay. Now, if they want to cover this by issuing share, so the share price will be this, each share price, right? So this is the number of shares they are going to issue, because this part is the amount of money they need to raise. This will be the per share price. So you get how many shares you need to issue. So it should be 883,534 shares they are going to issue. Okay. So these are the problems from the dividend theory chapter. Then the rest of the questions are from capital structure chapter. Question number 6. Ms. Kraft owns 50,000 shares of the common stock of Copperhead Corporation with a market value of $2 per share or 100,000 overall. The company is currently financed as follows. Company has 8 million shares with a market value of 16 million, short-term loans 2 million. Copperhead now announces that it is replacing 1 million of short-term debt with an issue of common stock. Okay. What action can Mrs. Kraft take to ensure that she is entitled to exactly the same proportion of profit as before? Look that Miss Kraft owned 50,000 shares. Am I right? Out of 8 million. If you calculate this, it will be like 0.625%. So this is her proportion of ownership. So this will be her entitlement, proportion of entitlement for the dividends too. Now, since the company is issuing additional common stock, if she doesn't buy additional common stock, her proportion of ownership will decline, right? So her proportion of ownership is 0.625%, am I right? And the company is issuing share of additional 1 million, which is equal to 6,250. That means she just need to borrow additional 6,250 and then invest in the additional shares, so that buy additional shares so that her proportion of ownership remains the same, or her entitlement on dividend remains the same. Okay. The next question is, Corp is financed entirely by common stock and has a beta of 1. The firm is expected to generate a level perpetual stream of earnings and dividends. The stock has a price earnings ratio of 8 and a cost of equity of 12.5%. The company's stock is selling for $50. Now the firm decides to repurchase half of its share and substitute an equal value of debt. The debt is risk-free with a 5% interest rate. The company is exempt from corporate income taxes. Assuming are correct, calculate the following items after refinancing. So you need to calculate cost of equity and overall cost of capital after refinancing. Now look at this. So cost of equity is 12.5%. Am I right? So that is our previous cost of equity. Now, as the debt increases from we have learned that as company uses more debt, the cost of debt will go up, and so is the cost of equity, right? Total return of the company should remain the same. Am I right? So total return of the company previously was equal to cost of equity, which is 12.5%. Now company issues debt, and we can solve for return on equity, which is, if we solve for RE, which is 20%, that means cost of equity, which means that, look, previously company was an all equity company. That's why its cost of equity and its return on asset should be the same. However, now as the company is issuing debt, its cost of equity should go up as the company becomes riskier. And we see that cost of equity is 20%. Question number 8 is very, very simple. Executive Chuck is financed solely by common stock and has outstanding 25 million shares with a market price of $10 a share. It now announces that it intends to issue 160 million of debt and to use the proceeds to buy back common stock. Buyback means repurchase. How is the market price of the stock affected by the announcement? Okay, so once again, it doesn't have any impact on the stock price. How many shares can the company buy back with 160 million of new debt? Okay, so this is a very simple one. So 160 million is the debt they issue, and each share has a price of 10, so they can buy 16 million additional shares. 16 million shares they can buy back. What is the market value after the change in capital structure? So market value of the company means debt plus equity. And 160 million of debt is issued. And what is the value of equity loan? Previously, the value of equity was 25 million. Now 16 million have been repurchased. So it will be 25 minus 16. Okay. So it is, and each share has a price of 10 million. As a result, the market value of the company is going to be 250 million. And what is the debt ratio? It's very, very simple. 160, which is the debt, and total value of the company is 250. So debt ratio is 64%, which means that 64% of the company's capital is coming in the form of debt. No one gains or losses because the company just issue debt and buy back common stock. So it's a simple change in its capital structure. So it doesn't make any gain or losses for the shareholders. Okay, so this is my explanation of the answers of week 8 workshop questions. But after that, if you still have any question, or if you have difficulty understanding any of the answer, let me know by email. Okay, thank you very much.